Hey everybody, welcome in. Welcome to Wednesday's Real Talk on Real Estate. Jerome Maldonado here, and today I'm excited. You know, a lot of people, every time we do a housing market update, the echo's too bad. I would say let's open that. And yeah. So I'm excited today because we're doing a housing market update. And so anytime we do a housing market update, everybody gets excited because everyone wants to know exactly what's happening in conjunction with the pandemic, how it's getting affected, what interest rates are doing, and what lumber and building costs are, and are homes still selling, or is there going to be a dip in the market? And so that's the biggest thing, is people want to know what in the world is happening in the market today, and how is this and how is it going to affect you personally, how is it going to affect us investors, and how is everybody going to move forward into up and coming months. And so one of the big things is being able to be aware of up and coming trends and what's happening. So just to kind of update you guys right now, you know, I see things a little differently than most people because I'm immersed in the market in every facet, right? So I'm teaching and educating people about it, one. So I'm always doing research in that regards. But I live it, breathe it, and smell it every single day. We have projects going on in Puerto Rico. We have projects going on up in the Midwest. We have projects going on the West Coast. And I have stuff right here in the Southwest. And so we have the Albuquerque, Santa Fe market covered. We have the Phoenix, Tucson market covered. We're doing a ton of stuff over in the Kirtland, Seattle, the Northwest area. And we're actually working on some stuff over in California right now. We have to make those markets, we have to make that market more impressive to us because of, one, the taxes, and two, there's not as much growth stimulation. We're only about 4% growth stimulation in the market up in the far West Coast, up in the California market and so forth. So anyways, nonetheless, let's get started on some of the housing market updates that you guys actually want to see and hear about. And so one of the big things right now is April housing market is down by 5.9%. Ladies and gentlemen, that's big. It's the lowest, it's the biggest dip that we've had all year. March was down by about 2.5% to 3%. And so one thing that people got to understand is that the market has been hyperinflated. Now, what's the reason though? One of the big things is, what is the reason that the housing market has dipped? You know, is it because people just aren't buying, or is it still an inventory deal? And so one of the biggest things is figuring out where to find that information. So I go to the U.S. Census Bureau report and I look at this stuff so that I can figure out exactly what the U.S. Census Bureau is doing and look at all the numbers. You know, we find out that there's an increase in April on housing prices by over 20%. And why is that? Is that what slowed down the market? Because housing prices are up by 20%. Well, lumber prices have went down a little bit, but they're still higher. Year to date, we're still 60% higher than we were at this time last year. And there's not enough lumber to service the demand right now. There's such a housing demand that the lumber prices still right now, we're still trying to, the demand exceeds the sawmill production ability. So lumber prices are still super high. And so what you got to think of, you say, okay, what drives supply and demand? It's the need for product. And so even though lumber has dropped on its peak from its highest level of cost just a few months ago, we're still in excess of 60% on lumber costs year to date. And so you got to remember though that if production of homes, if home production and home construction exceeds the production of lumber, the prices are going to stay elevated. Now, once the need for that lumber drops, and then the lumber prices will drop if the demand for housing drops. But we still haven't hit that threshold yet. Here's some examples. So look, if you take the average median home sold this year, it was over $372,400 for the median household. Okay, so median household that was sold, median home nationwide, was over $372,400. Now, the average home that was sold was $435,000. That's the average home sold, which is crazy expensive compared to 1 year ago. That's last year. If you think about the numbers from last year, you'll see that 45% of houses sold were under $300,000. More than 45% of those homes, less than $300,000. In April of this year, year to date, 27% of homes were under $300,000. So we have almost a 20% variance year on year out of home prices that are under $300,000. So the majority of homes now that are being sold are well over $300,000. So we're not seeing very many homes that are. We're not seeing very much homes that are selling for less than $300,000 on the market, and the average home sale is over $435,000. And now that's because, one, there's been an escalated pricing, right? We've had an inventory crisis all year long, and so we're taking a look back at this stuff and saying, okay, what's going to be the breaking point? And so many people are saying, okay, should I invest? Should I rent? Or how should I go about parking my money? Should I buy a house for my personal use? Or should I live in an apartment? And so they asked millennials, and millennials, they did a research study, and the millennials, when they were all the millennials that bought this past year, they did a research study, and they said that more than 60% of millennials interviewed had made a mistake in purchasing a new home. And the reason is because they didn't account for the expense of home ownership, maintenance of a home. And so they'd much rather be in an apartment. Okay. Now, is that going to affect our purchase rates? Is that going to affect our home buyer rates? Is that going to affect how the market is going to move forward? No, because there's still a housing market inventory crisis that we're still battling. Okay. So now understand that if 1 year ago, 45% of homes that are on the market were under $300,000, and now only 27% of the homes that are on the market under $300,000, what does that do for the first-time home buyer? What it does is it diminishes their ability to go in and buy that home at a lower price. So they have to make more money. So it decreases the amount of people that have the affordability for that. And so since unemployment's been lower and a lot more people haven't been able to get into first-time homes because there's a lack of inventory, prices have escalated, there's still a demand issue for people that desire to be in homes. Okay. Now, I like looking at all the stats and information and really getting a good understanding, because this helps me really understand what I'm going to do as an investor and a developer in different market sectors. And so I'll sit down and I'll go back and I'll research a lot of this stuff just to make sure that when I do, I have a good understanding. I have a good understanding of where I should put my money and how I should invest. So right now, people are asking, Jerome, have interest rates dropped? Are they going up? What's the projection? Is that what is affecting the market? Since April, we lost 5.9% of our home buyers. And in March, we lost a little under 3% of our home buyers. What's projected for May? And are we going to continue to see this drop? Well, interest rates in April actually dropped. We were at 3.4% on our annual percentage rates in April. Now we're at 3.1%. At the end of April, we were at 3.1%. And now today, last week, we were at 3.18%. But in spite of the drop in interest rates, we're still seeing that home ownership and home purchases are still lower by over 5.9% of what they were in March. So interest rates don't seem to be affecting that. Although, if you take a look at our mortgage updates on our 30-year fixed rates, right now, a 30-year fixed mortgage will cost you about 3.07%, which is still 0.3% higher than the record low, but it's substantially lower than we've ever seen in history. And so we take a look at that stuff and we say, okay, is this going to continue? And if we see an increased interest rates, I know that they're projecting the interest rates by the end of the year to be in excess of 4%. Now, understand that every 0.5% that goes up, it takes a home buyer $10,000 more in earned income to purchase the exact same home. So for sake of example, if somebody can go out and afford a $500,000 home and they're making $150,000 a year, what you have to understand is the same buyer has to make $160,000 a year instead of $150,000 to buy that exact same home for every 0.5 point that goes up. So what that separates is the buyers on the lower end of the market, let's say someone's making $70,000 a year and can afford a $400,000 house. Now that same person, if the interest rates raise by 2%, they have to make over $40,000 more. So that same person making $70,000 now has to make $110,000 to afford the same house that they can afford today if the interest rates raise to over 4% in just the next few months by the end of the year. And so that will slow down the market. And so when we're taking a look at inventory, we're taking a look at interest rates, we're taking a look at home sales and investing, all this stuff needs to be taken into consideration. But we sit back and not having a crystal ball in front of us, we sit back and try to make sense of all of it to see how we would deploy our money and how we're going to invest. And there's a lot of other factors that go into that. Right now, President Biden is proposing a capital gains tax increase, right? For those people who make over $1 million net taxable income per year. And so for a lot of investors that are making that, they're trying to hit them first. Now, here's what's happening though. Here's what they're doing. Now, in prior years when we've seen tax hikes, so in prior years when we've seen the taxes jump on capital gains, they typically implement that several months down the road. Now, Biden is trying to back that up, and he's trying to get this implemented under a special circumstance that this gets implemented. The capital gains tax increase gets implemented as of April of 2021. So sorry if you investors that haven't sold off your real estate, including myself, we're going to land up going from having a 20% capital gains tax to a 39.5% capital gains tax. And then that's not even including state capital gains tax. That's just the federal side of it. And so all of that stuff will affect if people are buying rental homes. Are they going to be keeping their inventory, or are they going to be selling their inventory? So if I'm an investor and I sit back and I'm a buy and hold type of person, I'm not somebody who goes in, buys, flips, sells. We still do that in some market sectors. Obviously, we build and develop residential subdivisions. So we're always buying vacant land, and we're building houses. Now, that gives us our cash flow. That gives us our capital basis to go in, put down payments on properties. It gives us our cash basis to be able to go in and grow and continue building out our portfolio of commercial real estate. But as an investor, I like to buy and hold. Then I don't have to worry about capital gains taxes because I just buy and hold. And what I land up doing is I land up just utilizing the cash flow that comes in from those rental properties to be able to deploy and live on and be able to invest into other stuff. And we're only paying taxes on the passive income that comes in from our properties, the residual income, the rental income that comes in from all our properties. And so from the housing market perspective, if the capital gains tax increase gets implemented and backed into April, investors more than likely will slow their buy and sell pattern. More investors will start holding their inventory, which is what we urge people to do. Now, if they're holding their inventory, this will still halt the amount of inventory that's on the market. And so hence, we're still going to have an inventory issue on the real estate market moving forward. And so for those of you guys who are listening to this stuff and you guys are sitting back going, okay, how do I make sense out of this for my investments? Well, I'll tell you right now, house prices are still very high. Interest rates are low. So a great time to get into properties and a great time to invest in properties. And the reason being is even if the cap rate is low right now, what you have to remember is that, let's take, for example, I don't want to lose you guys here, but I'm going to do this in the simplest layman terms that I can to explain this to you as an investor, as a homeowner, as somebody who's going out aspiring to invest in real estate, whether it's buying land and building a house, whether it's going out and buying a multifamily apartment complexes, no matter what that is, I want to make sure that you guys have an understanding of how the low capitalization rates, the low cap rates are functional in the market. Because if you would ask me a year and a half ago, when I kept seeing sub 5% cap rates, I would sit back and go, my goodness, how can people get into these properties without feeling such a need of risk at a sub 5% cap rate? And so I sit back and I go, okay, if I pay cash for this property, the capitalization rate is the amount of money that I make on that property if it's completely paid off. So if I'm making less than 5%. Let's just call it 5% for sake of ease. So we see 5%, okay? We say we make 5% on $1 million, okay? So you make 5% on $1 million. Now, let's say that that $1 million, you only put $200,000 of your own money in. Well, you're only making 5% on that $200,000, and then the rest of the money is getting deployed back into interest payments minus what you're paying in interest. So what makes the cap rate work is that, let's say you have $800,000 that you're utilizing on a payment that you owe the bank, you owe your institution. But let's say that you're able to get institutional money at 3.9%, at 4%. The other 1% you get to make on the bank's money. Now, exactly like the bank makes money on your money, the low cap rates, because interest rates are so low right now, what's making the low cap rates work is that you have the ability to go in and earn income on the bank's money. So you're able to go in and generate capital on that $800,000. So you can go in on that $800,000 loan and still make 1% on the bank's money, which you couldn't do if the interest rates were at 5%, because 100% of your money, your cap rate, your capitalization rate is going back to the bank in interest. Now, what you have to be careful of is, let's say you get a hard money lender or a bridge loan or a high interest rate because your credit or the asset isn't stable. What you have to remember is, if you get a higher interest rate in excess of the cap rate, you have to be able to service that debt from the property. So even if the property has a 5% cap rate, but your interest rate is 6%, now you're paying the bank or the institution or the lender, whoever you're borrowing the money from, 1% out of your cap rate. Does that property afford that difference and variance in the cost? Okay, so all that has to do with underwriting. Now, let's get back on track here. I did a little research from the National Association of Home Builders, and I went in there just to look and see what the National Association of Home Builders was looking at as far as the housing market, and I wanted to give you guys an update on some of that stuff as well. Home sales for the year, from the beginning of the year to now, they are down. According to the NAHB, the National Association of Home Builders, home sales all the way through the month of April are down. Now, they didn't give an exact percentage, but they are down. We just can't sustain the inventory. And so what's happening is there's a huge demand and we can't sustain the inventory. So what the NAHB is saying is that it's not down because people are not buying. It's only down because we cannot sustain the inventory that's needed to get those sales up. And so they go back and you say, okay, you take a market sector and you say, okay, we need 150,000 homes built in the next year. But if you take all the builders that are out there and you take everybody that can build and all the inventory that's available, and if you sit back and you can only build, if there's 150,000 needed and you can only build out 90,000, that means that we're short a supply of 40,000 rooftops. And so what this means for you, if you guys are looking at information, you guys want to buy land, build a house, and generate capital, like I talk about often, you want to sit back and you want to take a look at the numbers in your local market. What is the need for rooftops? And then you go in and you can call the building and zoning department, call them up and talk to one of your building officials and just ask them, how many permits went in last month and how many were approved? And how many are in for this month and how many are approved? And then if you just track back a few months and you multiply that out by 12, you'll see exactly how many homes are projected to be built by the end of the year. One, the city municipality only has the ability to underwrite and do plan reviews on so many homes, so only so many of them are going to get approved, right? A lot of these municipalities aren't hiring right now, and so if you take a look at what's happening, you can just use a multiplier. And so if you just take a month to month multiplier and you just take the last 3 months and then multiply that number in quarters, there's 4 quarters in a year, right? So if you take 3 months, multiply it by 4, or if you just take the last 2 months and multiply those out, each month you take an average of them and then multiply that average by 12, that'll give you the projected amount of homes that are going to be built in your area by the end of the year. And if that need if the amount built doesn't fulfill the need, then what's going to end up happening is that there's going to be a need for more home construction. Now, look, each one of us is a small minnow in a big giant ocean. Okay, so you have to think about this in regards to you individually. So if you're sitting back, there's pessimistic people that sit back and say, well, if I can't get materials, how the hell am I going to build a house? Well, just remember, you're a small minnow in a big giant ocean. You're not like the D.R. Hortons of the world, or the Pulte builders, or the Kaufman and Bro, the KB Homes, and the Toll Brother builders of the world, the LGI home builders of the world. You're not these big mass production builders. You're a minnow in a big ocean. I'm a minnow in a big giant ocean. And minnows in a big giant ocean can make millions upon millions of dollars. The question is, have you done the homework and research to find out if your market pushes for it? Now, I'm going to tell you guys that new home sales year to date is still up by 33.7%. So in spite of April being down by 5.9% and March being down by 3%, home sales year to date are still up by 33.7%. Okay. So what this means is that who saw the mass majority of these numbers? Well, the Northeast saw a huge amount of these numbers. The Southeast saw a big percent of these numbers, and the South saw a big percent of these numbers. The market with the lowest amount of home built and home sales year to date was the West. So the California market, the whole West Coast is the lowest end of home sales along it. Now, remember, California takes up the mass majority of the West Coast, right? So even if you take a look at Oregon and you take a look at Washington State, who have massive growth right now, they're still a small sector of the West Coast in comparison to the population and the area that the California takes up. So if you're someplace in the Southeast, you're someplace in the Northeast, and you're someplace in the South, I encourage each and every single one of you guys to go down, talk to your building officials, and see how many permits are currently up for plan review, and see how many permits were issued last month. Take a 3-month collective inventory of those, take an average, multiply that by 12, and then see what the projected growth is and the need for single family rooftops in your area over the next 12 months. And if there's a need, you can go start looking for land to build a house, and you as a small minnow in a big giant ocean can go in and capitalize on that. I promise you that there's enough inventory to service your 1 home or 2 homes for you to go in and generate and make a profit. And so even though home sales are down, there's still a huge need. So if people are sitting back going, okay, is this bubble going to burst? Is the housing market declining, and is it indefinitely going down? Have we seen the top end? My answer to you is it's really tough to tell right now. With everything that's happening, it is extremely tough to tell if the market is really on a long-term decline. So when you look at all the numbers, it doesn't look that way. It looks like right now we're still having an inventory, a demand issue, and we're still having a supply issue. And so when you marry the two and you look at our availability of lumber being a huge factor in that, to me, it looks like there is still a huge need for housing in our market. Now, as interest rates start to increase, it's going to and house prices continue to escalate. If they continue to escalate, it's going to really compromise our first-time home buyers' availability to get into homes. So as that starts to happen, the market will start to level out. Those are the 2 factors that are really going to start stabilizing our market. An appreciated value that goes up so high that first-time home buyers, the mass majority of people, cannot afford anymore what the house is being sold for. And then if interest rates raise, then it gives them the inability to afford a home in that median price range. Remember, that median house price range is over $372,400 right now. And so as interest rates rise and as the median household price rises, it starts reducing the amount of single family home buyers that can get into that market. And so once it hits a certain threshold, there's a point of diminishing return, right? There's only so much the market can bear. And once it hits that point, people start renting homes. They start renting homes and they start renting apartments more so than they start actually buying homes. And so we're going to move in that direction over the course of time. The question is that time today? I don't foresee that that's the case. In fact, I see that if people still want to buy land and build houses, if you go in and do your homework to see if your market threshold supports that, then I would go in and buy land and build houses, because that's what we're doing. We're doing it in Washington State. We're doing it here at home. And we have developments going in for the single sake of profitability that we can deploy back into other assets. Now, I want to make sure I took a bunch of notes here. Want to make sure I didn't miss anything and make sure that we got everything in. So lumber is dropping, but prices of lumber are still up in excess of 60% year to date than what they normally are. Now, we are projected to see about a 30% decrease in lumber. Now, will that happen? As long as supply is inferior to demand, we're not going to see that happen, but at least we're not going to see it happen really quick. But we are starting to see lumber inventory come in from Canada. And so as more availability of lumber and lumber mills, lumber mills open up and we see more availability, it's going to start stabilizing those lumber prices and other material prices. So nonetheless, if you guys are looking, if you guys have questions right now, this is a good time for you guys to deploy any questions for those of you guys who are watching. Look, ladies and gentlemen, it takes a lot of time, effort to be able to sit down and put all this information together for you guys. So if you like the information that we're bringing to you guys, the information is of value to you, give us a thumbs up. And also pound it and hit that bell button and subscribe to our YouTube channel. But give us a thumbs up if you like the information, that we're bringing to you guys. Give us a big fat thumbs up. If you guys are here, you're rewatching this video, just put, I'd like for you guys to, right now, to just type in the chat and put rewatch and join us for more content just like this. Now, ladies and gentlemen, if you guys have questions in relation to the housing market and or comments in relation to the housing market, this is a great time to implement those questions. Now, I'm going to talk to you guys a little bit about the business side of how this affects you guys before we end this today. We got a few more minutes on Real Talk on Real Estate, and I want to make sure that we bring you guys full value for the day. Now, we have some Washington State, Seattle project updates. We're moving forward with permitting. We're starting to get people back to work. A lot of the municipalities were behind on permitting, and so I'll tell you guys that now that we're getting people back to work with the pandemic, we just have to push people back to work. You know what would help stimulate the market is if we could go in and get more people going back to work quicker. It would help stimulate the market in advanced stages. One of the big things that's taking a long time in the housing market is the fact that we cannot get permits back as quick as we used to. So let's say, for sake of example, in our municipality, it used to take us about 30 days to get our permits. Now it's taken us 90 days to get permits. Well, in the Seattle market, we're going in and submitting for permits, and it's taking us anywhere between 8 and 9 months to get full permits after a full correspondence with the city, where back a year ago, before the pandemic, we were able to get permits in 4 months, full plan review. So in half the time 1 year ago. So what we need to do is we need to get more people back to work and more people processing paper and allowing us to go in and start building these. Now, these homes and our commercial projects, our residential projects and everything, and that'll help stabilize the market a little bit quicker. Now, in regards to you as an investor right now, look, I'm telling you guys, hands down, I know there's a ton of fix and flips people that are watching this stuff out there. And I'm even going to call out Cody Spencer on this right now because the clever investor. And so Cody, if you happen to see this video, I'm calling you out. I'm happy to do a little rebuttal with you. I'll tell you that he wants to go in and get people working with him to do fix and flips. And I'll tell you guys, I'll challenge that. I want to get as many people working with me, directly with me, to buy land and build new houses. Because one of the big things right now is we have an inventory need. It's in certain markets, that inventory need is not going to deplete anytime soon. And so the variables to buy land and build new are so much substantially lower than the variables in fix and flipping, buying an old house and fix and flipping. So in most markets, your average profitability on a fix and flip is someplace between $30,000 and $40,000. Now, if let's say you go into a house, the cooling system alone goes out and you have to replace it, unforeseen expense, your profitability just went down the drain, pot zero. Okay, if there's foundation issues and you have to stabilize the foundation, spend $50,000, now you're in the negative. If you have to replace the roof that you weren't expecting, you got to spend $20,000 replacing the roof, profitability goes down to zero. Look, ladies and gentlemen, I hate fix and flips. I love buying old buildings, renovating them, and then for cash flow, keeping them and getting them stabilized. And I'll tell you, that's one of my best business models. Most of our residual income comes from old assets, old beat up buildings that we purchased really inexpensive, renovated, leased at a very reasonable price, and the cash flow from those is unbelievable. And it works in office, it works in retail, it works in industrial warehouse, it works in any sector of the market, so long as you buy at such a depreciated price that you can rent it at a reasonable rate. There's a need for that inventory. I own a ton of it. We have a lot of it all over the place. Now that stuff I'll buy. Sometimes I'll stabilize them and I'll flip those, but they flip based on the income model of that property. And so every once in a while, I'll flip it and I'll upgrade to a larger property. I'll say, you know what? I just bought this building for $500,000. I dumped $100,000 into it, and I'm going to sell it now for $1 million. I'm going to take that $400,000 in profit plus everything that I have into this building, and I'm going to buy, instead of a $1 million property, I'm going to go out and buy a $5 million property or $4 million property with that exact same capital, because I was able to flip in upscale to a new property. Now, single family homes. Look, ladies and gentlemen, I'm not a buy, fix, and flip on the residential sector. Hate it, never liked it. I've done it. My profitability has always sucked. There's too many variables. Maybe I was just horrible at it. And I'll tell you, I know construction inside and out. I know renovations. I've been in this industry for well over 25 years, and we've made millions of dollars building, doing renovations and doing new builds. I've never been a remodel person. I've never liked doing remodels on residential projects for that exact same reason, is that you open up those walls, and what you find in those walls, you never know how it's going to affect your underwriting and your overall costs. Now, because the market is so stimulated, you're already paying an elevated price for a lot of the real estate anyways. Now you're going to go in and try to squeeze out a profit and hope that we get more escalated pricing. Look, ladies and gentlemen, bad business model, absolutely hate it. I'll tell you guys right now, the variables are too much. When you build new, the hardest part of building new is the first one. And I'll tell you why. Because you don't know 100% of all your costs if you've never done it before, unless you're working with an experienced professional like myself. Why? Because we have spreadsheets, we have cost breakdowns. We teach you guys exactly how to do it. So I would challenge Cody Spencer to say, hey, Mr. Clever Investor, keep being clever. I love you. All this respect in the world. But I'll tell you right now that the best thing that you can do with a decreased variability and increased profit margin is buy land and build a house new. Because then you're building it new. The variables go down. You don't have to worry about what's in those walls. You don't have to worry about a bad foundation. You don't have to worry about a bad roof or bad heating and cooling systems. You do all this before you even break ground. You get all your pricing, you get all your bids, and then as you move forward, you just unfold the process that you've reversed engineered through the exact same process. Now look, ladies and gentlemen, if that sounds attractive to you, and instead of making $40,000, $30,000 on a fix and flip, maybe, how about going in and making an extra $80,000 to $100,000 in the exact same amount of time? Because I'll tell you that I've never got into a fix and flip that I was able to get out of in less than 3 months. And I can go in new construction, provided that I can get permits from the time I turn dirt. I can go in and do a 120-day build, or I can go in and do a 140-day build, which is more what I do now because I hate the stress of doing a 120-day build on a 2,500 square foot house. But I can do it at turnkey in 140 days and see a profit of over $100,000 on every single house that I build. Now, of course, we're seeing strong 6 figures on every house we build because 1, I know the markets, 2, I know how to build right. But what if you suck at it at first? And even with my help, you still suck at it. What if you had the ability to still make $80,000 on your first build because you messed up $20,000 of your margins, not knowing what the hell you were doing and overpaying $2,000 here, $500 there, $1,000 there, $80,000. Ladies and gentlemen, that's life-changing for 95% of the population. So look, understand there's still a need in the market. With all the information that's available out there from the U.S. Census Bureau and from the National Association of Home Builders, I'll tell you that everything that still supports that there's an inventory crisis, and we don't have enough inventory for the market right now. The biggest thing is you being able to go in, dissect your market, make sure that you go down to your building and zoning department like we talked about prior, find out if there's still a need in your market for more homes that are currently going to be built so that you can be that small minnow in a big ocean and take advantage of big profits for you. Now, ladies and gentlemen, again, if you like the content and the information that we're doing, pound that thumbs up button, subscribe to our YouTube channel, and I look forward to seeing you guys next week on Real Talk on Real Estate.